We start off over here, guys, and we say demonstrate knowledge of asset allocation processes and the mean variance model. Now, just before we start, just very, very simply, and guys, I just really want you to just let's keep it as simple as we can. Okay. The mean variance model, it's in the words, guys, mean variance optimization. So and remember, guys, as soon as we go, we're working in the mean variance model. There's always three variables that drive the model. Number one, the two of them are written over here. Well, number one is the mean, the average returns, or the returns. Number two, the variance, the risk. Okay, and number three, of course, is the what we call the correlations. So whenever we're working with a mean variance optimization model or mean variance model, whatever you want to call it, okay, there's always three inputs to the model. There is the mean, which is nice and easy because that's the first part of it. There's the variance, that's the second part, also nice and easy. And how do I optimize them? I also need to take into account the levels of correlation between the various assets. Because remember, guys, it is portfolio. We're dealing with a portfolio of at least two assets. The minute there's at least two assets within a portfolio, well, those two assets will have some level of correlation with each other. Okay. As a basic intro, let us now carry on. Understand the origin of mean variance optimization. Okay. What we're trying to do is mean variance. We're trying to make sure that we get the most amount of return for our level of risk. We're going to come to these concepts time and time again, because remember, guys, mean variance optimization, there's the mean, there's the variance. I want the most amount of mean for a certain level of variance. Okay, that's what we often refer to, guys, as the risk return trade-off. Okay, good. We're looking, of course, guys, at the overall risk of the portfolio, okay, as opposed to individual investments. This is the whole concept of MPT, modern portfolio theory. We're looking at the investments as a whole. Okay, and this obviously brings, as we know, guys, I hope I'm boring you to tears, and this stuff is so stock standard and familiar to you guys that you don't really need to hear it a second time, but we'll say it anyway. You guys all know Harry Markowitz. Okay, he was the what we would refer to as the father of MPT. Okay, and he came up with these various theories. The keys behind the theories are diversification. There we go, the concept of diversification. In other words, when you invest in a certain amount of different types of stocks, okay, you will be nicely diversified. What will go away? What will go away will be your unsystematic, specific, or what we call idiosyncratic risk. That will go away. What will you be left with? You will be left with systematic risk, because we know, guys, systematic risk, which are the risks of the system, things like of the economy, interest rates, foreign exchange rates, etc. Of course, these cannot be diversified away. Okay, and that's just a basic intro, guys. You're all, I'm sure, very familiar, particularly coming out of CAIA level 1, with those particular concepts. We move over the page over here, and of course, one of the keys behind mean variance optimization is the trade-off between returns and volatility. Okay, and I just want to show you, as we start off over here, okay, very important just to remember, okay, the basic calculations, okay, and let's start right from the bottom, right from the beginning, and get some nice calculations under our belts. Okay, let's look at an example. Asset A has got a 50% probability of increasing by 10%, okay, or falling by 6%. Okay, and asset B has a 50% probability of increasing by 12 or falling by 8. Straight away, what do we see, guys? Both asset A and asset B have got what we call expected returns of 2%. Now, knowing how advanced you guys are, I didn't show you the detailed calcs behind that in the notes, but just for sake of completeness, let us just make sure that we do have a sense of how we calculate that. So we go over here. Let's just look at asset A, guys. Okay, and asset A has got a 50% chance of increasing by 10%. So what we would say is 0.50. You're comfortable with that? That's its weighting, times by 10%. Plus, asset A has also got a 50% chance of losing 6%. So times by a loss of 6%. Okay, half of 30% of 10 is 5%, nice and easy maths, and losing 6% to 50% chance is minus 3%. So that what we would call over here, guys, the expected return, okay, is 2%. Everyone comfortable how we got to that? And of course, you would do the same thing with asset B. Very important to remember, guys, okay, that albeit that asset A and asset B have got exactly the same expected return of 2%, if you have a brief look, it's not difficult to see, okay, that they, just clean up over here a little bit, okay, it's not difficult to see, of course, that their risk profiles are very different. Okay, and on a brief look, one would have to come out and say, well, asset B is more risky. Now, just a quick word on risk. I know this is not FRM, but we still need new. And guys, I do warn you, of course, some lovely stuff on risk is coming. Topic 4, risk and risk management, okay, which excites a bit of a quant and a FRM like me as well. Fantastic stuff coming. Okay, let's talk about risk for a second. Now, why, if asset A and asset B have got exactly the same expected return of 2%, would they have a different risk? And remember, risk, okay, is the variability or the volatility of those particular earnings. And to come to the 2%, well, asset B's got a much more volatile picture to get to the 2%. It's a probability to go up by 12 or down by 8. Whereas asset A, the range or the variability of returns is not as variable or wide as it is for asset B, because there it can go up only to 10 or down by 6. You've got a much bigger chance of larger gains on asset B or bigger losses on asset B. Okay, and guys, straight away, nice and easy stuff, just in case you were missing topic 2 from CAIA level 1, we'll bring that back for you, and let's calculate standard deviations for both of these assets. How do we do that? Well, what do we know? The calculation for standard deviation, and because of standard deviation, you can see once I've got my answer, what do I have to do with my answer? I need to square root it. That's why we've got that one over there. Okay, and it is the expected return of 10, expected return of minus 6, less the mean, which I've calculated of 2, less the mean over there of 2. Don't forget to square them both, because by squaring it we get rid of all of our negatives, and of course I have to assign a 50% probability to each one. Once you've got your answer, of course, you don't forget to square root it, because that is the key to taking it from. If you hadn't yet square rooted, what would this, if I just clean up over here, guys, what would this answer over here be equal to without having square rooted? That will equal to your variance. But if I want to go from variance to standard deviation, which is my key risk measure, I square root the variance. And that's what I've done over there. What do we notice over here, guys, coming out when I do this calculation for both? Standard deviation for A is an 8% standard deviation, and for asset number B, the standard deviation is of course higher, 10%, which is what we expected. And why did we expect it? We expected it because the variability or the variation or the range of returns in asset B seems to be much wider or variable than that for asset A. Okay, we move on a little bit. And sorry, just before we move on, is if we're just looking purely at the trade-off between returns and volatility, of course I'm going to pick asset A, because why wouldn't I? I get the same level of return for either asset, but lower risk on asset A. So on a risk-adjusted basis, of course, I'm going to prefer asset A. Okay. We now talk about utility. Okay. Utility now is introduced. Okay, and utility simply is what the investor gets out from the return on their investment. Okay. Expected utility is just, again, the same story like we did over there. If I've got many different utility options, I would need to weight them based on their various probabilities as well. We look over here, and guys, in most cases, this is a stock standard utility calculation over here. Okay, but there are times that they would give you, okay, their own utility function, and of course if they do, then you forget what you've seen over here and you work with their utility function, because remember, utility function is what the particular investor gets from the return. These are stock standard ones that we use, but again, Nothing has to be stock standard, and of course, guys, it will depend on what they give you in the particular question. Okay, now here are your calculations. That's what they've given you. Remember, there's two different possible outcomes, therefore I weight them 50% to each one. Okay. How did I get to the 1.10? Well, the 1.10 is what? Okay, the 10% return. Let's go back over there, show you that. There's the probability of increasing by 10 or falling by 6. If it falls by 6, it goes down to 0.94. And there's the going up by 12 and the going down by 8. Where did the 0.5 come? We're just weighting the different probability, a 50% chance of each one. Okay, and those are your equations. Let's now go and calculate, okay, the utility. And guys, just a little bit, just in case you were bored of some nice easy stuff, of course we throw back in some log functions, some statistical functions. Okay, that is the way that we solve for these. And look over here. Okay, so I take my 10,000, which is my investment that I made, and that's an assumption that I've just put in, guys. I've assumed we made an initial investment of 10,000. I plug that in, times it by 1.10 to the log, and times it by a half. Okay, why do I times it by the log? That's just the way we do. We calculate the utility function, guys, which gives us, as you can see, an interesting answer. It's got very little related to thousands and things like that, like it was before. It's just a way of getting it to a standardized answer for us. Run those answers over there, guys, and utility for asset A is 9.22. I do the same calc for asset B over our page over there, still using logs, okay, and I get to 9.2253. Okay, so if we look over here, there is your utility 9.2270, okay, for A, and it has 9.2253. Utility of A is higher, and if I'm just looking purely at utility, then yes, I would go for investment A over B. If I was looking at risk-adjusted returns like we did initially, yes, I would also go for investment A over investment B. Okay. We look over here, guys, at an example of a utility function. Okay, and again, the reason I specifically put this in for you guys is just to show you there are different kinds of utilities that we use. Now, this particular utility function has been described as, what is the utility over here? It's purely the root, okay, of the amount of investment. That's all. Okay, so you will have to work in your exam, if they do give this to you, with the utility. If they ask you to compare the utility or just to calculate the utility of one investment, okay, you will then need to work within their utility functions. Okay, so let's have a look over here. Investment amount 10,000, 60% chance of earning 25, 40% chance of 10, and you should be very happy because, of course, the probabilities, as we know them, guys, do sum to 100 or to 1, which obviously is a huge relief, as it should be. Okay, and the question is, should the investor keep his money? Sorry, this is an error. That should be 10,000, of course, not 1,000. Should the investor keep his money in cash, the 10,000 in cash, or should he invest that amount? We know the probabilities of what he can earn if he invests it. Okay, we look over here, the utility of holding cash, okay, using their utility function is purely the root of what? The 10,000, giving you 100. Okay, the utility of investing, if he now decides he's going to invest in it, okay, well, it'll be 12,500 as the first one, because he's got a chance of making that 10,000 an increase of 25, or it can go down to 9,000 if he loses 10,000. And again, use their functions, which is the root of the investment. So I root the investment. Of course, I times them by the respective probabilities, and I come out with an expected utility of 105. And based on that, the utility function of an individual will be higher if he invests in the particular investment A, as opposed to if he holds it in cash over there. Nice and simple, nothing too crazy for us to worry about there. But again, this is looking at investments or asset allocations based on the concept of utility. Okay, and guys, particularly Lisa, not particularly Lisa, but Lisa, with I have you in mind when we talk about ratios and formulas. There are going to be quite a lot coming out of this particular chapter, chapter 9. Good news, of course, much less from chapter 10. Okay. Looking at risk aversion, we work with a concave, okay, utility function. Okay, convex would be that way, concave would be going that way. What does that mean? That the risk averse investor, okay, in compensation for taking on more and more risk, as the risk levels increase and increase, what happens? As risk goes up, goes up, goes up, what does he want? Higher and higher return. Does that make sense, guys? And that's normal. No one's prepared to take on more risk if you're not going to compensate them with additional return. Okay. The utility function can be expressed as follows. Okay. When I take into account mean and variance of return. Okay, guys, and as we go through, you're going to see many different functions. You have to address in the question exactly what kind of calculation they are asking you for. Okay, this particular one over here, guys. Okay, and now we introduce the lambda. What does the lambda tell us? The lambda is, okay, the degree of risk aversion. We know that is the mean or the expected return. Nothing's changed over there. That is the standard deviation. And of course, when I take the standard deviation and I square it, that's what would be called the variance. Nothing new over here. I wish I could teach you something new, but this is all stuff that you guys know already. Okay, just something a little bit against the intuition, a little bit in terms of risk aversion. Okay, of course, we know the greater the level of risk aversion, the lower the level of utility. If you're not prepared to take a risk, well, then you're not going to get much out. That's life, isn't it? Okay. Now, as we carry on over here to something that doesn't seem to be so intuitive, the risk averse investor, okay, he's risk averse, he's got a positive lambda, whereas a risk seeking investor has got a much lower lambda, which of course is not so intuitive. You may well think it would be opposite, that a risk seeking investor should have a higher lambda. Not the case. He's got a lower lambda, which is his risk factor, risk aversion factor. Okay, and obviously a risk averse, his risk aversion factor is higher. He doesn't like risk. He's very averse to risk. That's what we call the lambda, like the risk aversion factor. He's very averse to risk. So just try and keep that in mind. Okay. We move on over here, and yes, unfortunately, guys, you do need to know that particular formula over here, but I have lumped it together for you in your new formula sheets. Okay. We now introduce not just not just means and variance into my calculation. We introduce some higher moments, which of course, as we know by now, guys, is skewness and kurtosis, okay, into our utility function. Now, and remember, guys, nothing's changed. Nothing's changed. It's all the same. These are all expected utility calculations. When I want my expected utility, what am I looking for? As any investor, no matter how risk averse you are, you're looking for the investment that gives you the highest amount of utility. That's all. Nothing crazy, nothing difficult, nothing mad. Just give me the highest amount of utility. How do I calculate that? Oh, well, here I'm going to be including skewness and kurtosis. The previous one, I just used means and variances. Okay. Good. And of course, you can see over here, when I now introduce skewness and kurtosis, okay, we look over here. So look at my calculation for utility. The mean less, okay, remember, I don't know how many of you guys, I may be giving away my age over here, but in my day we used to work with a concept called BODMAS, okay, and BODMAS in terms of an equation like this would always put the minuses, okay, right at the back, okay, so those are dealt with last. Okay, so what do you deal with first? Almost if I'm looking at an equation like this, guys, what I could do, assuming I wanted to make it a little bit easier for myself, I could bracket that, treat that as a standalone, treat that as a standalone, and of course treat that as a standalone, because remember, multiplication and division happens before subtraction and multiplication. Okay, or addition. Okay, so you've almost got 4 terms over here that you need to work with, guys. Let's just clean up here, make it a little bit easier, guys. Okay, what are my 4 terms? My 4 terms are the mean, the variance, okay, the skewness, and the kurtosis. Now remember, guys, in a question, they don't have to give you all 4. They may say, okay, we're only working today, we're only working with skewness, in which case, of course, you don't use the 4th term. Okay, good. Okay, and there we go. Let's have a look at an example over here. And really, guys, it's just a bit of a plug and play. And you can see in this question over here, here's my formula. Okay, but as you can see in the question, there's no kurtosis. See, I've just got variance and skewness, no kurtosis. Of course, I won't use that last term. Okay, and then it's just a plug and play, and I run my numbers, and I get to minus 1.18. Doesn't seem like a very nice answer, of course. You would seek an investor or an investment that'll give you the highest level of utility. Of course, I would need to compare this number with another investment to see which would give me the highest level of utility. Okay, we move forward onto page 7, guys. I'm still in utility. I'm just giving you another way of looking at it. Now I use value at risk. Remember, value at risk is one of the key risk management tools, which of course we're going to be seeing a lot more of when we get to topic 4, risk and risk management. Okay, and look what I'm doing over here. Nothing too crazy over here. Quite simple, in fact. There's my mean minus, I'm just going to open a bracket over here, guys. My lambda, which is my risk aversion factor, okay, divide by 2 times var. Remember, nice easy way to remember this and without having to learn too much. Remember, before I would take my lambda and I would times it by the variance. I'm not using variance as my risk measure. I'm using what is my risk measure? VAR, or value at risk. So you don't see the variance here anymore, but what you do see is, of course, you see your value at risk. And there's a bit of an example for you. Really, guys, I'm not going to spend too much time on it. Just a plug and play calculation. Again, I hope I'm boring you by now. The investor would select the investment with the highest level of utility. Don't be scared if you get minuses. It's not abnormal. It can happen as well. Okay. Let's have a look over here. Okay. We now look at risk aversion based on the asset allocations decision. Okay. Previously, we looked at the degree of risk aversion. Okay. Remember, we talked about the degree of risk aversion is called the lambda. Now we're going to show you how to calculate that. Okay. How do you calculate that? Okay. Expected return less risk-free over the variance of the portfolio. And what would you tell me if you're thinking back a little bit to CAIA level 1? Wow, that looks quite a lot like the Sharpe ratio. Very similar. Okay, very similar ratio. Okay, because remember the top part is what? Expected return over less risk-free, which is what we always call our excess return. Remember that. Okay, away we go. The more aggressive the portfolio, guys, you remember this? It goes a little bit against the intuition. The more aggressive the portfolio, okay, the lower the lambda. Okay, the less aggressive the portfolio, and what would you say? The less aggressive the portfolio, you would also tell me then they are the less aggressive. Then these people are considered to be called what? These are risk averse people, and your lambda would be higher. Okay, and sorry guys, but you need to know that formula as well. Okay, and the last little bit over here, guys, now we talk about what happens when I introduce risk aversion and growing liabilities. When do my liabilities keep growing? And this is going to be all the fun that we need to deal with in topic 3 under institutional asset owners. As I mentioned before, chapter 13, pension fund portfolio management. Okay, when you're working with a defined benefit plan, in other words, the pension plan promises to pay out certain benefits. Okay, those are growing liabilities. Okay, Here's my calculations. If you have a look over here, okay, and I'm looking at, and now what we're doing is we're coming out with the various asset weightings. We'll show you more of this as we go. If you look at the calculation, V, value of the fund, times by expected return, less lambda by 2. Lambda, of course, we always know by now, guys, is the risk aversion. VAR, okay, I'm just using that as my method. I could use others as well, of course, times value times return. Okay, very interesting formula, but of course here I'm not growing my liabilities. Here in this, if I now decide to work with a defined benefit plan as the learning objective has told me to, I need to grow my liabilities as well. So this particular formula is really just on the asset side. I haven't yet grown the liabilities. Let's grow those liabilities a little bit and let's see how the formula changes. It is the value of my fund, V, times the return I can expect on that fund, nothing's changed, minus lambda over 2, nothing's changed, times VAR, nothing's changed. But now look what's happened. I take value of my portfolio less the liabilities on that portfolio, and not just less the liabilities, but less the liabilities growing as well, as they tend to grow in the particular fund as well. Okay, yes, it is one that we do need to know as well, guys. But again, guys, as you move through the formulas, just work with the formulas, okay, and just try and work with them as much as you can, and just try and think through them. And don't learn this as Formula 1 and that as Formula 2. Learn this one and then say to myself, well, what if there's no growing liabilities or liabilities? Well, just take that off, and that'll equal that one, won't it? Number one. So work cleverly with the particular formulas that we need to work with, guys. Okay, learning objective 9.2, knowledge of how we implement MVO, mean variance optimization. Okay, and we've spoken about this a little bit before. Okay, I'm not going to move do too much detail on the little bit of theory that we have over here. Let's shoot over the page. Okay, and when I look over here, guys, remember this. If I just take you back a page, remember the key behind this particular learning objective is implementation. Now, if it's implementation, okay, and I'm at the process of I've selected my investments. Okay, investment A or investment B, call them what you wish, however many I've got available. I'm ready to implement. What I now need to decide is how I'm going to weight those particular investments, how much weighting I'm going to give to investment A and to B, because this particular learning objective said we want to talk a little bit about implementation. Away we go. Let's go over the page now. So you can expect over here, okay, general normal calculation. What about if I've got two assets over there? What if I've got an asset with growing liabilities, etc., etc.? And the key coming out of this particular learning objective is to be able to calculate the various weightings as I need them. Okay, let's look at some of my key variables, guys. N is the number of asset classes that I'll be dealing with. R is my returns, and W is my weightings. Okay, good. The following points relate to my model, and guys, there should be nothing new to you here. Okay, there's always remember in terms of the MVO model was a model that came through from the traditional modern portfolio theory and traditional investing. We always there work with the risk-free or the riskless asset. Of course, we know, guys, my weighting sum to 1. Short sales are allowed. Okay, remember this is sounding a little bit CAPM-ish. I hope it reminds everybody of that. Variance, covariance matrix is used. In other words, we are taking into account the correlations between the various assets. We also look at the level of risk aversion. Okay, remember that's the lambda. Nothing's changed. We've seen that before, guys. Okay, and excess returns have a direct relationship with risky asset weightings. Let's have a look over here. Okay, I've got a risky asset, and guys, we're starting over here right on the bottom, nice and simple. This is just a general case of one risky asset and one risk-free asset. Okay, nice and simple, nothing too fancy over here, just a nice simple question over here. Okay, of course, and based on this, guys, we will build on further and further onto our model. Okay, risky asset return is 12%, risk-free rate is 3, degree of risk aversion, or lambda, is 6, okay, and your variance is 0.04. And guys, just be mindful of the difference between variance and standard deviation as you go through. Variance has 0.04. Okay, remember, to get to standard deviation, I would just square that number should I wish to get there. Okay. Now remember, W is always going to be giving you the risky assets weight. Let's have a look over here. So it's 1 over lambda, 1 over 6. Yes, sorry guys, you need to know that one. Times the risky return less the 3%, which is the risk-free return, divided by the variance, and I get to 0.3750. Okay, when I say that, okay, that is the weighting on for the risky asset. Taking you back up to my rules over here, the weightings of the portfolio sum to 1. If I'm investing 37.5% into my risky asset, guys, which is the one part of my equation, okay, then obviously how much then will go to the balance? Of course, nice and easy math, which is 62.5% will go to the other asset. What is the other asset? That's the risk-free asset, the riskless asset. Okay, good. Away we go. What happens if I now introduce? And as we go, guys, as I mentioned, we're going to be introducing more complex scenarios. This was the stock standard basic scenario. Let's introduce a little bit more. And remember, guys, okay, again, don't waste your time learning separate formulas, because now I've got mean variance optimization. I'm trying to calculate weightings, but now I've got growing liabilities. Well, that's fine. So I'm going to add on to my formula. To which formula? My first one. So the first part of this formula, till I plus the liabilities, is the same. Okay, so of course, guys, just try and make your job and your work a little bit easier by just really looking at what is required of you, okay, and what is new and what is just a bolt on to what we've seen thus far. Okay, when I've got growing liabilities, L is my liabilities, and the relative size of liabilities to assets, and this fancy squiggle, call him what you wish, okay, is really, it's the covariance between growth rates and assets and liabilities. In other words, what's the relationship between how assets and liabilities grow? And of course, that's over the, okay, your standard deviation. Nice and simple. Okay, nothing too, so your variance, nothing too crazy over there. Okay, away we go. Okay, and I've thrown you in a little bit of example over here. Nothing too crazy. Okay, really, guys, it's just a bit of a plug and play. Let's just make sure we've got all the answers. Okay, 1 over the risk aversion factor, that's your lambda. There's your 9 over there. Okay, your rates of return on asset is 12. Okay, risk-free rate is 5. Okay, there's your standard deviation, but I want the variance, so I just square that to get back to my variance, plus 0.8, which is the relative size of liabilities to assets. 0.03 is the covariance over the variance again. Just plug and play, guys. And my weighting for the risky asset is over there. Okay, and nice and easy. Nothing too crazy. Nothing too crazy over there. Really just coming out with your calculations, of course, for your risky asset, for W. Of course, when we know the weighting for the risky asset, well, then I know the weighting for the risk-free asset, which is just 1 less that particular number, and away we go. Okay. Learning objective 9.3, mean variance optimization. But now I don't just work with one risky asset versus the risk-free asset. I want to be throwing in multiple risky assets. Wow. And we know, guys, we know that the mean variance optimization, okay, traditional finance, modern portfolio theory, all works with the introduction of risky assets. And what do we use? We use this thing called the efficient frontier. If I show you a picture over here, guys, Okay, this is the efficient frontier over here. Why is this the efficient frontier? It takes all of the investments in the market, everything. Okay, look over here, we call it the global minimum variance portfolio because I take all my investments in the market globally, I plot them. This is just your stock standard um, modern portfolio theory stuff over here, guys, and I get to an efficient frontier. And if you have a look at what is on the efficient frontier, and the efficient frontier is the optimal place, of course, to invest, because what does that give us, guys? On this axis over here is the standard deviations. That's obviously equal. Standard deviation really just means risk. And ER is expected return. That stands over there. On this axis over here, there's your return. Okay. And fancy term, don't get overly bogged down. Net risk-free rate, RFR, is the risk-free rate. And that's, of course, why, and it's just something important to remember, the risk-free rate is not zero, so it's not going to sit over there. Just because it's risk-free doesn't mean you don't get a return on it. So the return is lower than if it's a risky investment, but there is, of course, some return, and that's why the risk-free rate does not sit all the way down at zero. Okay, and what can we see over here? Let's just have a quick look. This is really revision from CAIA level 1. Portfolio A dominates portfolio C. Why is that? Because A sits over here on the efficient frontier, has got a very low level of risk, and it is risk-free. C is very risky. Look where it sits. Let's just clean up here. Okay. C is very, very risky. Look where it sits, all the way there on the risk scale. Very risky, earning the same return as A. So, of course, you'd be stupid to invest in portfolio portfolio C, when you can invest in A for the same return. Okay. B also dominates C because, yes, it's the same level of risk, B and C, but B is being nicely compensated. Remember what we spoke about there previously, the concave level of the curve. We spoke about that a little bit earlier. Okay, good. And this is what we call the risk return objective, that an investor will obviously seek to be on the efficient frontier when he looks to see which assets he would like to invest in. Okay, I'm not going to spend too much more time over there. Just 2 points that they like to ask, interestingly enough: constrained versus unconstrained optimization. Okay, unconstrained means there's no constraints. Remember, optimization just means I'm looking for the best possible allocations that I can get. Okay, if I'm unconstrained, means there's no limit on allocations to any fund. Okay, what's the downside perhaps of this? Okay, it may result in an over allocation to funds that have got strong historical performance. I might start to look and invest greater weightings into funds with good past performance. Okay, good. Too much emphasis then is placed on historical correlations. Okay. A constrained optimization, I put certain constraints in place. In other words, you can only invest 5% per fund. You cannot do short sales. Whatever other constraints we put into place, and this reduces tail risk as well as increasing diversification benefits, because I'm not unconstrained, which may result in me investing only in one fund. Perhaps I've now put constraints in place that will make sure that I am more diversified. Okay, over our page, 9.4, demonstrate knowledge of the MVO with hurdle rates. Okay, what are hurdle rates? Okay, as soon as I add a new asset to my portfolio, okay, we need to say it will add value if the return on the new asset is greater than the hurdle rates. What is my calculation? Okay, I say to myself, expected return on the new asset less the risk-free rate must be greater than the return on the portfolio less risk-free rate times the beta of the new asset relative to the optimal portfolio. Okay, and here's a little calculation for you over here, guys. That'll tell the hurdle rate will be how much I need to be earning on my new investment that I add to the portfolio to see whether or not it will be a viable asset to add to the portfolio or not. Okay, good. And of course, guys, remember they can, now that you have your formula for the hurdle rate, they can really ask it in any way possible. They can say to you, oh, Bob, they can give you all the variables. Okay, let's just look over here. Variable number 1, 2, and 3, risk-free rate is just repeated again. And they can say to you, oh, by the way, work out what the beta is. Okay, that sometimes is what CAIA likes to. They like to get a little bit clever and say, well, let's see if we could just trick the guys a little bit and make sure they know their formulas. And of course, we just try and play around a little bit with some of the numbers. Okay, so just be a little bit mindful of it, that they can do that for you. Okay, we move on a little bit. That is the end of hurdle rates. Please make sure that you have a sense of that over the page. Learning objective 9.5, demonstrate knowledge of issues using optimization for portfolio selection. Okay, we're going to interpret optimizers as error maximizers. It's an interesting one. We talk about illiquid returns, large-scale optimization. Of course, we always go back to the high moments, guys. And of course, why do we do that? Because we are in alternative investments, and alternative investments focus quite heavily, of course, on the higher moments. Okay, good. Okay. When looking over here, guys, when I'm looking to optimize a portfolio, let's say, for example, I'm trying to optimize a portfolio size of 300 assets. Okay. And remember, 300 assets have all got links to each other. I've got to look at each and every asset and say, well, how is asset A linked to asset B? How's B linked to A? How's B linked to C? How's A linked to C? And if that were so, okay, look at the massive amount of different pairs or estimates that I'm going to work with. And guys, my suggestion is that you do look at this calculation, so one that they like. And when I'm working, say, with 300 assets, my calculation of how many different estimates are out there will be n minus 1 divided by 2. Remember, 2, I always look at the correlations between two assets. And 44,850 estimates for a 300 asset portfolio. That's massive. How would we reduce the amount of work that I need to do? Well, instead of working with different assets, 300 different assets, I can still work with 300 different assets, but remember what we spoke about in factors, what we spoke about chapter 8. What I can now do is I can isolate not investments or assets, but factors that relate to them. And obviously that will greatly reduce. If I'm only working with factors and not assets, there may be 10 or 12 different factors that relate to these 300 assets. That'll make my job, okay, a whole batch easier. Okay, we talk about portfolio optimizers. Okay, these determine the correct allocation for a diversified portfolio. Okay, the problem sometimes when we work with formulas like portfolio optimizers, like mean variance optimization, what sometimes comes out is that there are the output from these models or these optimizers often gives me extreme weights for the portfolio. Okay, we often refer to them as error. It's a bit sarcastic, of course, because they're supposed to be portfolio optimizers, and they end up giving too many weights to the wrong assets or extreme weights to assets, and we call them error maximizers. A bit sarcastic, of course. Okay, good. The process tends to give high weightings to assets with high returns, low volatilities, which often leads to large estimation errors. Okay. And output that is not considered to be reasonable. Okay, good. And what we're going to do is, as we go through this, we look at right on the back end. This comes, I think, at the end of this particular chapter. How do we resolve this particular issue of error maximizers? Because you remember, guys, everybody does make use of portfolio optimizers, mean variance optimization, etc., etc. So how do we work with these particular models and still try and make sure that everything works out as it should and doesn't result in too many errors? We will talk about that, of course, as we get to the end. There's a lovely little model called Black Litterman. Okay, we'll talk about Black Litterman on the back end. Okay, MVO at higher moments. Okay, Alternative investments, as we know, guys, doesn't normally work within the normal distribution. Okay, it normally shows high levels of skewness and kurtosis. Okay, so these will need to be brought into your optimization process when working with alternative investments, of course. Okay, top of page 14, guys, sensitivity to the inputs. Okay, we talk about this concept called rubbish in, rubbish out, and just to cater, of course, for our Americans in our class. Okay, we will change that for you guys. I'm sure you're already making a comment over there. Let's Americanize this for you guys, and that's called garbage in, garbage out. So no matter where you come from, we we accommodate everybody. Okay, and there is your acronym. Okay, and remember, and what does this say? Remember, sensitivity to the MVO inputs, and remember, there are three major inputs to MVO: returns, variances, and correlations. If you put rubbish or garbage into any of these inputs, what will come out? What will your output be? Garbage as well. Okay, good. We move on a little bit. Learning objective 9.6. Okay, I'm now going to work with my mean variance approach like we've done throughout this particular chapter. But what I'm going to introduce now is what we call a liquidity or an illiquidity penalty. Okay, because and guys, I know I'm boring you. Why do I need to work with liquidity? Because I'm in alternative investments. They are considered generally to be illiquid investments. Based on that, I need to incorporate liquidity into my picture. We know the two major kinds of liquidity, guys. There's market liquidity. Market liquidity is when an investor will need to sell his asset for perhaps a lower price than what he would have liked to, because the market just is not there. Okay, things like, okay, why would there be market liquidity for, and how would we know about market liquidity? Generally, when you've got your bid ask or your bid offer, some people call it different things, okay, and that particular range is very wide. In other words, there's a huge gap between the buyers and the sellers. That would indicate that there's a lot of market liquidity risk present. Okay. Of course, that risk would increase during times of market stress, and of course, much more so with privately traded securities and alternative investments. Funding liquidity is, of course, when the funding dries up and one is not able to finance one's positions due to a lack of funding liquidity in the market. Okay, good. So based on that, we can see quite clearly, guys, that there is an issue of liquidity relating specifically to alternative investments. Okay, and based on that, okay, we need to introduce what we call a liquidity penalty function, which is denoted by that. Okay, and what does that show me? That shows me investors' dislike for illiquidity within my portfolio. They don't want too many illiquid investments, so we need to take that into account via what we call the liquidity penalty. Okay, and there is your formula for that. Nothing that we haven't seen thus far. Okay, except the new entrant on the block, which is liquidity L. Okay, is the liquidity of the portfolio measured by this particular equation. Okay, and what we have is the level, investors' level of preference for liquidity. Something very important to remember, guys, that this particular function will always be a positive number. Okay, how do we calculate levels of liquidity? The more liquid the asset, and unfortunately, again, it's not so intuitive. The more liquid the asset, the lower the level of L. The less liquid the asset, the higher level of L. And it makes sense, of course, guys, because remember, guys, look at this last equation. The last equation says what? It's a minus. In other words, I'm penalizing you if there's no liquidity. So if there's less liquidity, I want a higher value of L. In other words, a higher penalty due to lack of liquidity. So it does make sense, but just try and work everything through as we go through that. Do you have to know that formula? Yep. Okay. What are some of the takeaway points, guys? Okay, for illiquidity adjustment. Number one, the penalty function is always positive. Okay, the illiquidity level, okay, goes from 0 to 1. 0, you are completely liquid, and of course then there'll be no penalty, will there, because it's a 0 to 1, which is the maximum level of illiquidity. Okay, and when I multiply the product of the penalty function and the level of liquidity, that will penalize the return in a mean variance optimization process. Okay, so just be careful, just be mindful of those three particular points. Okay, what happens when I try and introduce factors into the mean variance approach? Can we do that? Of course we can. Okay, now instead of working with specific learning objective 9.7, instead of working with asset classes, I can also work with factors. And guys, I'm not going to spend too much time over here because we dealt with this extensively in chapter 8. Okay, and based on that, I give you a little bit of an equation. They don't tend to ask this too much. Okay, but this is the linear regression equation that I would use when trying to calculate my return on the asset for exposure to a certain factor. Okay, I would not spend too much time on that. Okay, a little bit on the back end over here. Okay, when a manager wants to reduce exposure in his portfolio to a certain factor, okay, and the target is always denoted by be that. Okay, you add the following constraints to the model that you want to make sure that your area of exposure is less than the target level. Okay, of our page. Okay, we now look at learning objective 9.8, knowledge of how to mitigate estimation error risk in mean variance optimization. I don't want to scare anybody, of course, but as we know, when we see estimation error and risk like that, we know there's a little bit of quants coming our way. Okay. Start off with estimation, guys. The starting point for estimating the future returns is historical data. Well, that'll only be true, of course, guys, if we are using what kind of a model? An empirical model when I use backward-looking data. Okay. The problem with alternatives is I don't have so much back or historical data. Okay, and I need to make a certain adjustment for this particular error that may be present for this level of uncertainty. Okay, so we work with confidence levels, as I warned you a little bit earlier. There is going to be a little bit of quants over here in this section. Okay, so we work a little bit with confidence levels, things like that. Okay, standard error. Okay, the standard error is always denoted by, okay, over here, your standard deviation over the root of the sample size. Okay, formula number 1. Why do I have a standard error at all? I have a standard error because I'm not working with the entire population. I'm working with the sample, and of course certain errors will come in as a result of that. Okay, good. Assume that the asset's got an estimated annual return of 5. That would be my estimated mean, or my, call the mu. Standard deviation of 10. 20 years of data are being used. That will be my sample size. And I want to work with a confidence level of 95%. Step 1 is you calculate your standard error, which is 10%, which is the standard deviation over the root of 20, which is the root of the sample size. And here's my standard error, 0.0224. At a 95% level of confidence, we use a factor of 1.96, and that's of course the Z. If you go look at the Z table, normal distribution, that's where you would pick that one up from. Okay, and what does that do for me now? Okay, what that does for me with a certain level of confidence, and now I can work out, I can say to myself, okay, the estimated return was 5%. Now, why don't I just use that 5%? Well, I can't. I could only use that 5% if that was the exact answer, but it's not the exact answer because remember, I didn't have all the numbers. Okay, I had insufficient return history. So I worked with what I could. So I came up with a 5%, but I've got to give myself a bit of a range to work within because I'm not working with exact numbers. So I take 5%, and now let's introduce my range. How do I introduce a range? I go plus or minus what? My Z factor of 1.96 times the standard error of 0.224. Okay, and running with these numbers, I multiply that out, guys, and that gives me to an answer of sorry, I do think this should be 0.0224. Okay, my apologies. We'll just clean that up for you. Okay, which is 2%, of course. Okay, so that one was correct. This obviously was just a bit of an error might have crept through there. Okay. What does this the bracket answer give me? It gives me 4.38%. What's my answer now, guys? My answer is 5% plus 4.38 and 5% minus 4.38, which then tells me that my range is going to be between 0.62% and 9.38%. And how do we conclude? We can conclude and say we are 95% confident that the actual return will fall between 0.62 on the bottom end and on the upper end 9.38%. Okay, good. Okay. Okay, and we need to do that, of course, guys. The reason that we do that, of course, is because we don't have exact numbers or a complete history. We've got to work within what we have. Okay. We come to the back end over here, guys. I'm sure people are quite excited about coming to the end of it. Okay, and we remember what we spoke about before, that there are times that portfolio optimizer might in fact be an error maximizer, giving me too many errors because I am allocated too much to a certain extreme or a certain asset class. Okay, what reverse optimization and the Black-Litterman model comes and says is, let's work, it's reverse optimization. Let's work literally A about face. We'll start on the back end and we'll work forward. Okay, normal MVO starts where? With the inputs. And guys, I'm boring you to tears. What are the inputs? There's 3 returns, variances, and correlations. And from those 3 major inputs, okay, the model arrives at optimal weights. But remember, we said we don't like these optimal weights because sometimes it's not optimal weights, they're extreme weights, and in fact it has not optimized my process at all, but it has in fact increased my errors. They are error maximizers. Comes along reverse optimization and says, well, I'm going to put constraints in place for you. And I'm going to say, well, these are the optimal weights. Where do I get them from? I get them from a global portfolio. Okay. We then take those optimal weights. In other words, I'm working from the back end and I work forward. Okay. And I come to my, I reverse optimize my process. Okay, and these implied returns that I've put in are used to derive my portfolio weightings, still using, of course, the MVO approach. Okay, good. And what's interesting is the inputs for normal MVO are in fact the outputs under reversed optimization. Okay, good. Okay, and this was the Black-Litterman approach. Okay. It uses a system called reverse optimization, and it re-engineers things backwards going forwards. Okay, we have 2 different approaches. I wouldn't spend a little time. I've just mentioned it over here, guys. Please don't let that upset you at all. There is the unconstrained approach, unconstrained Black-Litterman. Okay, don't spend too much time. I've just mentioned it for you. We just talk about the normal Black-Litterman. That's what I want you guys to know. Like the unconstrained Black-Litterman approach. Don't spend too much time over there. Okay, guys, coming out of this particular chapter, okay, chapter 9, asset allocation and the mean variance, we've seen some very interesting things coming out of here, guys. It is quite an important chapter, of course. Okay, and unfortunately, as you see, probably coming out of, you think, wow, that was quite formula and equation intense. It was, and of course, yes, you have to know all those equations. But remember, guys, as you look to learn some of those equations, always remember that there are easier ways to learn them, of course, by just remembering that some are just additions to other formulas, some are a part of another formula. So don't go and learn everything as separate standalone formulas. Learn them intuitively and cleverly, of course. Having said that, of course, guys, I have just plugged them all together for you in your formula sheet, which is, of course, on your paces. Okay. Here, page 18, you've got a couple of checkers for you just to make sure that we keep you honest and make sure you are on board with those. Okay, there's a whole batch for you. Okay, and I've managed to dig up 2 questions for you as well, guys, on page 23 and 24. Of course, these relate to past exam questions. Remember, guys, they are not my questions. They are CAIA questions from past CAIA papers from 2017 to 2020. And they relate, of course, to assay allocation. They weren't in the assay allocation. They weren't, of course, at chapter 9 in the previous syllabus, but of course they relate to this particular chapter. All right, guys, we've got one more to go, chapter 10 for topic 2, which will be other assay allocation approaches, and then we will be finished with topic number 2.